Dear viewers, there has been uncertainty in the stock markets triggered by Trump's tariff move. We still don't know if these tariffs will be eased, rolled back, or made more punitive for India. But here is the thing, waiting and watching rarely works well in investing. So instead of second guessing Trump, a far better approach is to look for businesses that remain resilient, companies with robust supply chains, and reliable access to end markets. I recently shared 3 such tariff-proof stocks that should be on your watch list. Now let me bring your attention to something equally intriguing and much closer to home. This morning, while scrolling through my usual news feed, a headline in the Hindu business line caught my eye. Promoter holding in listed Indian companies has dipped to an 8-year low of 40.58% after a Rs 547 billion net share sale in the June quarter, as per Prime Infobase. And it is not just the promoters. Even FIIs have turned net sellers in July. So, who's stepping in? Domestic mutual funds, flush with liquidity, are aggressively buying, fueled by retail investor inflows and the broader trend of financialization. This rising demand has sparked healthy QIP activity as well. For companies, that means access to growth capital and a cleaner balance sheet. But for investors, it also means equity dilution. So where does that leave us? In a nutshell, the macro picture is cloudy. We are seeing insiders and promoters selling into an overvalued market, while public shareholding is rising via mutual funds and retail money. It's a setup that warrants caution, not complacency. While analysts gear up for earnings season, don't be surprised if forecasts turn out wildly off, especially in a world shaped by shifting geopolitical winds. In times like these, it pays to do what the best investors do: focus on signals, not noise. And few signals are as powerful as promoter buying, especially when it goes against the tide. While promoter holding across India incorporation is trending lower, some promoters are quietly buying from the open market, a strong show of conviction in their own businesses. These transactions are not just numbers on a screen. Behind them are people with skin in the game, betting on the upside they see before the rest of the world catches on. As always, I believe this kind of on-ground signal is worth far more than any headline or analyst projection. So, let us take a closer look at few such India-focused companies that can dodge tariff hit and where promoters are going against the trend, increasing their stake while others sell. The first is Arcade Developers, a real estate development company focused on premium and luxury segments. Its notable developments include entry into the high-potential Thane micro market and acquisition of Filmissan Private Limited. It has also announced its maiden dividend. It operates on an asset-light model with margins over 30%, return ratio over 30%, with zero net debt in the balance sheet, focus on cash flows and internal rate of return. The company claims a quick turnaround well before the RERA deadline as well. Pre-sales is a good leading indicator for the future prospects. For the quarter ended June 2025, its pre-sales have been the highest for the first quarter, growing at 17.1% year-on-year, and collections are up 41.8% year-on-year. What's more, the promoters have foregone their dividends to enhance shareholder value. For Rs 6.8 billion in top line, this company has a 5-year goal of reaching Rs 100 billion top line, with FY27 as an inflection year. Margin pressure amid competition is a risk to watch out for. The stock has seen insider buying in the recent months, Rs 18 million worth of stocks bought by the promoters at Rs 180. At current price, the stock is trading at 191 at just 6% premium. As a domestic-focused company, this company also qualifies to be a tariff-proof play and deserves to be on your watch list. The second India-focused business is DB Corp or Dainik Bhaskar. As a leading newspaper, it earns income from circulation and ad revenue. Apart from print media, it is focusing on digital user growth and on radio business. With the election-based issue now behind in the first quarter, the management expects core ad categories and digital to drive growth in the coming quarters. The promoters have said that they believe in the future of the company very strongly. The return ratios are healthy and the debt to equity ratio is negligible. The stock also offers a rich dividend yield of 4.4%. The stock has seen promoter buying worth Rs 33 million at an average price of Rs 271. In fact, this trend of insider buying has been going on since May. The stock is available at around similar level of Rs 272 and deserves to be on your watch list. The third candidate is APJ Surendra Park Hotels Limited. It operates in hotel and hospitality sector with a pan-India presence and over 5 decades of existence. It is the 8th largest hotel chain amongst the ones with asset ownership in India. It operates 35 hotels under the brands like The Park, Zone by the Park, Stop by Zone. And while these offerings cover the spectrum from economy to luxury, the upscale and upper mid-scale brands are the key business areas. The company enjoys a diversified portfolio of owned, leased and managed properties. It has reported highest occupancy of 92% in the quarter ended March 2025 and paid its maiden dividend. 41% of its revenue comes from food and beverages. The company has 17 to 18 billion capex planned over 5 years and has a strong launch pipeline. It has entered Mumbai market where demand and supply dynamics are favorable. It has guided for high-teen revenue growth with healthy profitability. The stock has witnessed insider buying in June, Rs 11.5 million worth of shares bought at an average price of Rs 153 per share. The stock is trading close to these levels. Now do note that this discussion is for educational purpose and does not imply any view on the stocks mentioned. Nonetheless, it is worth tracking insider buying in such India-focused businesses that could potentially offer a shield from Trump tariffs. Hope you found this video useful. Thank you for watching. Goodbye.